we started looking at interpretation of financial statements, and we used this question to look at some key ratios that you might be required to compute in the exam. However, even though the only thing we did last week was to compute all those ratios, you need to understand that for you at your level, the focus is not just computation of ratios anymore. The focus is more of analysis. How do you analyze these ratios? So we have not even touched the question at all, because all we did was just to compute. Even though for this particular diet, that will be the beginning of your solution, your ability to solve and to compute these ratios. Then basically, if you look at this A part of this question, where you were asked to prepare a report analyzing the financial performance of Alcom Nigeria Limited and its financial position for the year ended June 30, 2023 for 12 marks. The most part of this mark will be on the analysis. In fact, if you check the previous diets, the diet before this one and the upper one, they were not, in fact, they were giving you the ratios and they will ask you to analyze. So the core is the analysis. And that is what we're going to run through today, because good enough, we already computed all the ratios. So I will need you to see how I would go to analyzing this ratio in a very brief and in a way that you will not waste too much of your time, because it's just 12 marks. So you don't want to waste too much time after you must have spent a lot of time on the computation. And if you remember this question, the context given to us was they gave us the statement of profit or loss of this company, and also we're given their statement of financial position for 2 years. And we're told that they gave us that this company has 3 business segments. It has retail operations, it has online stores, and there's this contract it got, SOCH contract, which is Save Our Children Homes. So they gave us the revenue, the gross profits, and also the PBT of those business segments. And they gave us some background information. And in that background information, majorly, they told us that this company has been existing for more than 10 years, and it has been doing well. Its revenue, its profit has been stable. However, they got a new sales director, and the sales director brought the idea that they can sell their toys, because what this company does is selling of toys, that we can sell these toys online, but we will need funding. We will need funding. So they have been using long-term funding, they have been borrowing money from the banks, and the online shop has been operating very well for the last 14 months. So they are doing well. In fact, they even got a lucrative contract to supply customized toys all over the country. And they just signed that at the beginning of this year. And it's also doing very well, looking at the revenue and profits that they made from that contract. However, the MD of this company believes that they can still explore the online market, and even this contract they just got, they can extract it better. But the banks, they will need more money to invest into these new segments, but banks are not willing to give them money. Bank says that they don't have sufficient assets with which they can use as security for the money they will give to them, because most of the company's assets are already secured on one loan or the other. So the bank says, we can't give you money because you don't have what you can use to pledge as security. Because of that, they approached a wealthy investor, Alhaji Kyari, and Alhaji Kyari is the chairman of Jolly Investment Co. Limited. So, as a result of that, we were then, now, you work with that chairman, that Alhaji Kyari. So they called you investment analyst. So you're now required to advise Alhaji. So Alhaji gave you the financials of this company. That you should please analyze their performance and position. Then you advise Alhaji. And you are now required to do a forecast based on the outlook the company gave us. Do a forecast for this company. Now that's all. So last week we started solving it. We did all the significant ratios. We did we so we did the profitability ratios, we did efficiency ratios, we did liquidity ratios, and we did solvency ratios. Now, all these ratios we computed will constitute our workings. Now, what we want to do is to then do our report. And how do you do the report? So we start with the dates. And you see, this report we are doing is just a memo because it is an internal report from you, the accountant of that company. Then you are writing it to the chairman. So the dates that you would put, I would advise you just put the year end of the company, which is June 30th, 2023, or any date after that. So you, the chief investment analyst, and you are writing this to Alhaji what again? Alhaji Kyari or something? Yes, Alhaji Kyari, who is the chairman of Jollyman Investment Co. Alhaji Kyari, the chairman, Jollyman Investment. Okay, and the subject is analysis of financial performance and financial position of Agrocom Nigeria Limited. Okay, so when you're writing a report like this, you can segment your report into three. You could have the introduction, then the main body, then your conclusion. But this question already separated this question, so I can't really conclude that much because they said we should advise in the B part. So we are not really, so our conclusion will have majorly been the advice, but we'll see how we would go around that. So how do we do our introduction? So we can start with, we write, or since you are just one person, I write in respect of this subject matter. I will use the key ratios computed in the appendix to to analyze the financial performance and the financial position of Arocom Nigeria Limited. Then, before you start using the ratio, I would always advise that you can look at the financial statement of the company, especially the financial performance. You can look at their profits as well as their revenue and do an absolute line-by-line analysis, not for all the financial statements, but just those two items. And from what I'm seeing here, I can see that in 2022, the revenue of this company was 14.8 million. And in 2023, their revenue moved up to 24 million. If I do the calculation, if I do 24,000 minus 14.8, then I divide it by 14.8, that will give me the percentage increase in revenue. That means this company experienced a percentage increase of 62% from all their segments put together as far as revenue is concerned. And the last line item here, which is their profit for the year. If I do again 1620 minus 908 divided by 908, you would see a 78% increase in their profits. Sorry, please. So, as I was saying, I saw that there is a 62% increase in their revenue. And for my calculation of their profit also, their profit for the year, I also saw a 78% increase in profits. So that's where I'm going to start my analysis from. And that is where I would advise that you start most of your analysis from, because that alone, you have spoken, I mean, on an absolute level, you have analyzed their financial performance. So let me just write financial performance. I will say that the sales of the company improved by 62% from 2022 to 2023. Stop. I also say the profit for the year of the company also improved by this 78% from 2022 to 2023. I will say that. Then what does this show? This shows that the company is a profitable company and its cost management strategy looks impressive because it's able to maintain an improved profit for the year beyond the improve in sales, or beyond the improvement in sales. Okay, so all I've just said here is I looked at their sales, I looked at their profit. I saw that this is improving. But when I look at the improvement in the profit, it was even higher than improvement in sales. Then I told them that, okay, this company is profitable and its cost management strategy is impressive because it's able to do 78% increase in profit, even way above the improvement in sales. So that's where I'm going to start from. So as soon as you have settled that, then you move to the profits or the ratios. I will start from return on capital employed. You see it moved from 22% to 25%, though marginal, but there is an improvement. So let me quickly tell them that the ROCE, the returns on capital employed, improved from 22% in 2022 to 25% in 2023. Full stop. Then my second sentence will be, this shows that there is an improvement in the amount of profits that the company generates, the amount of profits that the company generates from the capital invested by the owners. That's the second sentence. The first sentence is just, I'm telling the examiner whether there's an improvement or there is a decline. The second sentence is me telling the examiner, what does that improvement, what does it mean? What does it show? The third sentence is, you need to then tell us why, what resulted in these improvements? What resulted in this improvement from year 1, 2022, 2023? Here, the context given is not much. They didn't tell me about whether they were increasing their costs, or the only thing I can relate it to is the fact that this company is well diversified. They are diversified into online stores and the associate contract, which would have significantly contributed into their profitability. It's part of what I can actually speak about. So let me attribute it to their diversification. These improvements, let me say, these marginal improvements, can be attributed to the diversified nature of this company, which have contributed to its profitability. Full stop. I'm done with it. We'll see. Then I move to the next one, which is net profit margin. It's improved just marginally from 6% to 7%. The operating profit margin too, marginal, from 9% to 10%. The gross profit margin from 30% to 32%. But one thing I can notice is this, is that the gross profit margin was over 30%, but from operating profit margin to net profit margin, it's a little low. It's low compared to this gross profit margin. So I need to say something about that. But at least I have to note that their cost of sales is quite high because not so I mean their cost of sales is okay because their gross profit margin is like 32%, which is good, very good. But the improvement is marginal between year one and year two. So let me just make that point known. The gross profit margin, operating profit margin, and net profit margin improved marginally. However, the gross profit margin, for the year of 32% is impressive. But when compared with the operating profit margin of 10% and net profit margin of 7%, they are low. And this can be attributed to high operational expenses. This can be attributed to high operational expenses for the year, majorly as a result of the new business segment that was introduced. So we believe that what will have caused the heavy difference between gross profit margin and operating profit margin and net profit margin is majorly because of the new business segments that was introduced. They will have to spend a lot of money to set it up, probably get staffs, do PR, and all these overheads will have cost that. But overall, there is an improvement. There is an improvement in the there's an improvement in the profits that the company generates from its sales. Okay, so I was able to put together these three because they have a pattern, and I was able to talk about their every difference, and I was able to show the examiner what will have caused that difference between GP margin and these other ones. And I actually also talk about the improvements they have in each of these ratios like that. Okay, so I'm done with profitability ratio analysis. Now let's move to efficiency. So from 2 times to 3 times, okay, for this one, the asset turnover, the asset turnover, the asset turnover improved from 2 times to 3 times in 2023, This shows that there is an improvement in the number of times that the company converts its assets to sales or revenue. And this can also be attributed to the new online shops and SOCH contracts. Then I go to the trade receivable collection period. This is an improvement, though marginal as well, but at least it's improved from 31 days to 28 days. So I'll write again that the trade receivables collection period improved from 31 days to 28 days. This shows that there is an improvement in the number of days. There's an improvement in the number of days it takes the company to collect its money from its customers. This can be attributed to its urgent need for liquidity, because they need money and banks are not showing up. Banks are not giving them money. So they need to turn to their customers and collect their money as fast as possible. This payables period, 53 days, 32 days, what we can attribute this one to, because this one I can't say is bad, because it's not bad. Because when you're paying your suppliers early, it's something that is good for you. But the fact that I know from the information given in this question that this entity is facing liquidity issue, they need money, even though they are doing well, they need money. So the supplier is being careful not to grant them an extended period. Majorly, that is why you see them paying earlier than previous years. Because the supplier is saying, I know the current challenges you're facing, and I would appreciate if you pay me earlier. So trade payables period reduced from 53 days to 32 days. The trade payables payment period reduced from 53 days to 32 days. This shows that the company pays its suppliers earlier than previous years. This can be attributed to the inability of the company to get extended credit period from its suppliers. Okay, maybe probably the suppliers don't want them to, or Well, don't let me say that because their inventory turnover is not so impressive. I want to say probably maybe they are selling very fast. Okay, I think they are because it's improved. It improved from this to this. Okay, let me say that. Or they are selling very fast and need to pay their suppliers early so they can get additional trade credits. Yes, and this makes sense because they just entered into new lines, new business segments like the online, the SOCH. So it makes sense for that they are settling their suppliers early enough just so that they can get additional goods and additional trade credits. So the business will keep moving. And especially the fact that banks are refusing to give them loans. So I'm sure they will not want to joke with the credit their supplier is giving to them. So it makes sense that they are paying them early enough. Then the next one is the inventory turnover period. That also improved fantastically because that means it takes them shorter days to sell their inventories now from 166 days to 113 days. So let's talk about that. The inventory turnover period improved from 166 days to 113 days. This shows that the company sells its inventory faster than previous years, than previous years. And this can be attributed to the new business segment, like the online shops and the SOCH contract that they got. And we believe that that's why they have improvement in inventory turnover. Okay, so that's it. That's the analysis for efficiency. I hope you are noting the sequence of my analysis, keeping it simple and direct, speaking about the movement, whether it's improving or not, making the examiner understand that I know the meaning of these ratios, telling them what this improvement shows, then attributing it to what is happening in the question, to what they told me in the question. And good enough for you, the context they have given us is not so much. All they have told us that this company has diversified and they need money, they are not getting the money. That is all. That's the story they have given us in this question. And from this story, I can relate it the way I want to all my ratios, which is exactly what I'm doing. So please just ensure you follow this pattern for your exam. Now, for the liquidity ratio, this one improved marginally from 3.94 to 3.97. Just marginal improvement. Okay, so let's talk about that. The current ratio improved marginally from 3.94 to 1 to 3.97 to 1. And this shows that there is an improvement in the ability of the company to settle its liabilities from its current assets. As it stands now, a 3.97 to 1 ratio is impressive. And this impressive ratio can be due to the retail nature of the company, where it will have to hold huge inventories. Okay, so I am just saying that why they are having a 3.9 to 1 ratio might be because it's a retail business, they sell toys. So you find out that they will have huge inventory, so which is making their current ratio to be impressive. But let's look at the quick ratio. You see that would just not be as high as, because by the time for quick ratio, you will have removed inventory. And as you can see, it's not so good. It's not so good. So 3.2 to 1.06. So the quick ratio improved marginally from an unstable state of 0.82 ratio 1 to 1.06 to 1. This shows that while there is an improvement, the state of the quick ratio at 1.0106 ratio 1 is not impressive. It's not impressive. Showing that the company does not have available liquid funds to settle its current liabilities. And this is confirmed. By their efforts to raise funding from investors. Okay, then finally is the cash ratio. And as you can see, is zero. Zero. The cash ratio declined from 0.11 to 0. This shows that the company does not have available cash and cash equivalents to settle its current liabilities. Shows that the company does not have available cash and cash equivalents to settle its current liabilities. Okay, so let me move to the last part, which is the solvency. So do you have any comments before I move there? Okay, let's go to gearing ratio. So for exams, right, I computed gearing ratio, proprietors ratio, debt ratio. Don't bother computing all of this. Just compute gearing ratio and interest cover. Because whether gearing ratio, proprietors ratio, debt ratio, those three tell the same story. The three of them are actually talking about the stability of the company in terms of the level of their operations that is financed by debt. Both three. Why gearing ratio is saying that out of your debt, only 32% out of your compared to your equity, debt is just 32%. So that means this company is heavily financed by the owners, heavily financed by the owners. So which also shows in its proprietors ratio. When you compare it to debt, is much, much more than the debt. And also, when you look at their debt ratio, looking at their debt on their total assets, you see that it's just a small fraction of their total assets. So this company is not exposed to financial risk and can still borrow much more money from what we are saying. So gearing ratio, proprietors ratio, debt ratio, they are pointing to the same story. So you can just compute your gearing ratio. You can, and for this gearing ratio, you can use this formula as we have used it, or you can use debt over debt plus equity. And don't forget that the debt we used was fixed interest debt. The debt we used was fixed interest debt, not all the total non-current liabilities. We use just the interest, the debt that we pay interest on, like the one that they will give you as 10% loan or whatever percentage preference shares. Those are fixed interest debt. So you can use it over plus equity. But in this, I decided to use debt to equity ratio. Okay. So let's do the analysis. I'll just analyze the gearing and interest cover. And as you can see, it's improving from 35% to 32%. And this improvement is basically because they have not been able to raise more money. That's why their debt ratio or their gearing ratio is stable, right? To a large extent, they have not been able to raise more money. And also, you'll see their interest cover ratio improved very well. And majorly two things: they are not raising more money, they are not been able to borrow more money, but their profitability keeps going up. So, which shows that this is a viable company to invest in. Because look at it, they have a profit that can pay the current interest 14 times. That is overly impressive. So let's say something around that. Let me start with the gearing, improving from 35% to 32%. So the gearing ratio improved from 35% to 32% in 2023. This shows that the company is exposed to very little financial risk, is exposed to an insignificant financial risk, and the improvements in interest cover ratio from 10 times to 14 times further uh, further strengthen the stability of this company, as it can cover as its present profits can cover its current interest or finance costs 14 times. 14 times. Okay, that's all for the analysis. So let me conclude. Following from the above ratio, the company is profitable from the standpoint of ROCE and gross profit margin, and its diversified nature shows that it can even do better, than what it's currently doing in sales and profits. Furthermore, it is efficient in managing its working capital, as shown in its asset turnover, trade receivables collection period, trade payables collection period, and inventory turnover period, which are impressive. However, its quick ratio seems low, probably because of its lack of funding. But with an impressive interest cover ratio of 14 times, it shows that it's less risky to provide funding to this company. Okay, so C, advice to Alhaji Kayari. From the analysis above, and speaking about its impressive profitability ratios, efficiency ratios, and solvency ratios, advise that we should invest in Outcome Nigeria Limited because it needs liquidity to further improve its profitability and efficiency. And its interest cover ratio suggests that it will not default. Okay. So the C part says that you should do a forecast of 2024 profits for the retail operations using the business outlook. And if you look at this part of this question, the note 6, it talks about the business outlook for the retail operations for the next year. It says, due to improved patronage, credit sales, which is made up of 70% of current sales, is expected to increase by 20% and the remaining cash sales by 10%. Cost of sales expected to increase by 12%. Bad debt expected to increase by, expected to be 10% of. Okay, good. So we can use this one to do a simple forecast. Let me see. They broke down sales into credit and cash. And what's the sales of the retail operations? 16,016. So they said that 70% of this 16,016 is let me see, is credits. 70% of 16,016 is credit, okay? While the balance is cash. And they're expected to increase by 20% and 10%. Okay, good. So let me do that forecast, but I have to do some workings. First, I have to do the credit sales. They said is this 70% of the current sales from retail, which will give us 11,211.2, and the remaining is the cash sales, which should be the total sales minus the credit sales. So that we should be looking at around 480.8. Then the forecast, they say that the credit sales would improve next year by 20%. So that should be 11,211.2 times 1.2. And they say the cash sales will improve next year by 10%. That should be 4,804.8 multiplied by 1.2. So what are we looking at? So this times 1.2, this one will give us 5765.76. This one 11,211.2 times 1.2. This will give us 9342.7. This one is by 10%, not 9. 4804.8 times 1.1 should be 528528. If I should add the two together, I can get the total sales from that's the forecast sales 9342.7. That's 14,627.9. Okay, this is wrong. This should be 13,453.44 plus 5285.28 should be 18,738.72. Okay, so let's do the forecasts, profits or loss statements for the year ended 2024. So the sales as done in note 1 is 17. They say the cost of sales will increase by how much? Where's the question? By 12%. And what was the current cost of sales? Cost of sales should be 16,016, which is the sales minus the gross profits. Okay, that will give me 11,216. That will be the cost of sales. So go to my workings. So cost of sales is 11,216 times 1.12 times 1.12. That's 12,561.92. So 12,561.92. So my gross profits is how much? 6176.8. And they talked about bad debt as well. They said bad debt would be, I think, say 20% of the current sales. Yeah, to be 10% of the credit sales. It said bad debts is will be 10% of the credit sales, which is 11. No, it will be the increase. 13,453.44. That would be 1345. So 1, 3, 4, 5. So what are we looking at? Was profit. So the profit should be around 1, 3, 4, 5, 4, 8, 3, 1, 8. Okay, so that's it for this question.